This is your LMAX Exchange technical update for Wednesday, August 23rd, 2017. Euro dollar. So the euro has been consolidating off recent plus 2.5-year highs, and we continue to wonder whether the market is going to break lower or break higher. Clearly, this is a market that's been in an uptrend in 2017, also breaking out above some meaningful longer-term resistance, and this does suggest that the market could trade a lot higher over the coming weeks and months. But at the same time, weekly studies are now extended and rolling over from those extended territory, which does suggest that we could see a bit more of a correction at the minimum before the market does consider a resumption of gains. This leaves the door open for setbacks to extend back towards the 115 area and towards the 115s, which also has that 50-day moving average. If we see a breakdown below 117 again, that could set the stage for this next major downside extension, because 117 has been a level that has been unable to be broken. Each time the market's broken below 117 over the past several sessions, it's come right back up into this range. So another breakdown could very well trigger that accelerated decline towards the 115 area. At the same time, if the market pushes back up above some recent highs from this week, which come in just over 118.30, it could set the stage for a retest and potential break of that 119.11 2017 high. But again, even if we do see the market break higher, it will continue to leave those medium-term studies overbought and continue to suggest that additional upside should be limited in favor of a more healthy corrective decline. And so the trend should continue at this point, but it still does favor a little bit more of a healthy correction before heading higher, which lends support to the idea that this market could see a bit more of a pullback into that 115 area at a minimum. Sterling dollar. So cable has come back down quite a bit since breaking to a 2017 high up towards 133. The market has now finally come back down into this critical previous resistance, now turned support area in the 127s. If we remember back in April of 2017, the market broke above a range resistance that had been capping gains off the plus 30-year low from back in October of 2016 at 118.40. And so the breakout did suggest that we were seeing a structural shift, a bullish structural shift, longer term structural shift that favors additional upside over the coming weeks and months. And so while we have seen these setbacks extend, the market is back into a territory right now where buying dips is becoming a more attractive strategy. And so if we see one more drop towards the 127 area, even into the 126s, it's viewed as an ideal opportunity to be looking for that next higher low ahead of a continuation of gains that ultimately takes the market up towards a measured move extension at 135. Only a close back below 25.90 would compromise this intensely bullish outlook now following that break above 127.75 resistance back in April. Dollar yen. So dollar yen continues to show signs of being very well supported on dips down into the 108s. The market has been basically range trading over the past several weeks and few months, with the market defined between 108 and roughly the 114, 115 area. And so this latest topside failure that we had seen back in early July has opened the door for a move back down towards these range lows, with the market now showing how well supported it can be down in the 108s. At the same time, while the market holds below 111, there is risk that any bounces continue to be very well capped in favor of additional declines to retest and potentially break below that 2017 low, which comes in at 108.13, going back to the 17th of April. A break below there would force a shift in the structure on a medium-term basis and could set the stage for a more pronounced decline over the coming weeks and months down towards the 102 area at a minimum. Again, if we break back above 111, it would suggest that the range trade is continuing and could open the door for an acceleration up towards the 114 to 115 area. Euro Swiss. So Euro Swiss has been in the process of unwinding from some strongly overbought extended studies that were seen several days back, with the market surging up through 110 and 112 all the way up towards the 115.50 area ahead of this latest minor pullback to allow for those studies to unwind. Overall, the structural shift has been in play now following that breakout above 112, which suggests that any setback should be very well supported into and ahead of this area here at 112, and in favor of that next major upside extension beyond the recent 2017 highs, the highest level since January of 2015, and up towards that critical previous base that was seen several years back, or a couple of years back in 2015, that had been supported at 120. Aussie dollar. So Aussie has been showing signs of carving out some form of a top over the past several days. Remember, the market several days back had put in a 2017 and plus 2-year high above 80 all the way up around 80.65, but those gains were not able to hold up, and the market had since pulled back. We did see a little bit of a bounce in recent trade, but it could be a bounce putting in a lower top now ahead of a continuation of declines. That will be confirmed, of course, on a break back below the low that we had seen on the 15th of August, which comes in around 78.08. A break below there would confirm the lower top and open the door for the next downside extension towards the 76 area. Dollar CAD. So dollar CAD has seen some setbacks over the past several sessions, but overall this is a market that's been showing signs of bottoming out off that 2017 low that was seen back in late July at 24.14. That was also a plus 2-year low. And if the market can hold up here and push back up, we could see the formation of a higher low, which would be confirmed on a break back above 127.80 about, and set the stage for a continuation of this correction towards the 130 area. We've highlighted a 38.2 fib retracement off the 2017 high to low move, that high that we'd seen back in May down to the low in July, and that 38.2 fib retracement comes in around 29.40, which would be a realistic expectation for this correction that has been quite intense over the past few months and this year. A 10% drop off since that May high down to the 2017 low. So again, additional corrective upside should not be that surprising to see. Kiwi dollar. So the market has been consolidating recent declines, and this is a market that has been very well capped on a cyclical basis up above 75 certainly, and we've seen that again with the market putting in a 2017 high, a plus 2-year high above 75 around 75.60 ahead of this rejection and sharp pullback back towards the 70 handle. If we see the market put in a lower top now over the coming sessions, then that will be confirmed on a break back below the 72 area. It could very well open the door for an extension down towards the measured move 70 handle, which would then expose a more significant decline back towards range support over the past, a medium-term range support over the past few months, which comes in around 68. SPX 500. The S&P 500 has put in another sharp rebound after breaking down to fresh multi-session lows, and the question again is whether this is a market that's going to be bid back up to fresh record highs, or if we're seeing the formation of some form of a top up here ahead of a bearish structural shift. The market, remember, several days back was able to rally back up, but stalled shy of that record high before reversing lower to a fresh multi-session low. And so if this rally up here extends but stalls out ahead of that previous weekly high, which was up around the 24.74 area, it could set the stage for yet another lower top and a breakdown below what is critical support for this market at 2400. A break below that level would likely open the door for a more intensified acceleration of declines, suggesting that we could see setbacks extending all the way back into the 22 to 2100 area. So a big break that would come in the S&P 500 if we saw the market established below 2400. Of course, until then, the trend remains intact and we could continue to see record highs. Gold. So gold has been chopping around over the past few months, but the market overall has been showing signs of being very well supported on dips, gradually putting in higher highs. And so this latest push to a higher high above 1300, just poking above 1300, and that's a 2017 high, sets the stage for the next major upside extension beyond 1300 and towards a retest of the 2016 peak at 1375. Any setbacks that we do see over the coming sessions should ideally be supported well ahead of 1240, but at the same time it would take a break all the way back down below 1200 to compromise this constructive outlook for gold.